Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of the gambling.com group. So, let's just get started and talk a little bit about who they are. Now, they own a bunch of websites. This is basically a look of all the websites they own. You may have been in some if you're into sports betting, or if you have been routed into different sports betting or odds websites by these websites. So, these are the media assets that they actually own, and these are the media assets that they're partnered with. If you go to USA Today and most recently The Independent, for example, I think those are their two biggest partners, you will see sports odds, betting odds. And those are often provided actually by the gambling.com group. And these are places where they'll lead you into other gambling websites. So this is something to note because this is how they actually make their money. Now, what they say in their annual report is that they are not a gambling company and do not offer any gambling services themselves. This sounds confusing because they're called the gambling.com group, but they're essentially an affiliate marketing company. So they're basically an online media company. All their revenue is through getting leads and getting people to sign up for other online gamblers, and those online gamblers give them an actual commission. So it's way different. And they have the websites that they have, the partners that they have, all to generate those leads, to have people coming in, looking at stuff, looking at odds, looking at potential websites where they can do sports gambling and whatnot, and going to those other websites that pay the gambling.com group for getting leads, for getting potential clients for them. They also have a portion of its revenue from data subscriptions, that is business to consumer, and then data syndication, that's business to business. So they do have a little bit of a diversified stream, but essentially just note that even though they have that name, they're not a gambling company. So that's pretty interesting. Now, I want to just dive into the financials. Here on Seeking Alpha, we get a pretty good overview of the income statement. So the revenues have been clearly growing stratospherically, essentially from all the way from 2018 to basically 2022. Now we have the trailing 12 months from right before this last final annual report that'll tell us the full year of 2023. They've been growing a lot, and this is great. The gross profit has grown right in tandem. The reality is that their cost of revenue is basically nothing. Creating more websites has a little bit of a cost. It has a little bit of upkeep, a little bit of, I guess, customer acquisition cost, but that's about it, really. And that's why also they have, if you look at the operating expenses, like they do have selling general administrating expenses, but they don't really have any research and development or anything like that. So their operating expenses are pretty in line with this number for the most part. And then the operating income here has also been growing, although a little slower than the gross profit and the total revenue. So it's important to note, and that's something to keep track of as they keep growing, is can they make those operating margins better? If not, that could show that they're spending maybe a little too much money on marketing, or that their marketing is not efficient. Their net income has been a little spottier too. You'll notice here, for example, in 2019, their operating income was $1.5 million. It went down to negative $1.9 million. So that's just something to note. Their revenue has not been their income has not been nearly as consistent as their revenue. But in general, the picture is pretty healthy, and something that'll show us why is if we look at the free cash flow. So that's the actual cash money that's generated. And essentially, the way we calculate cash from operations starts with net income, and then we add a bunch of these little things: depreciation and amortization, stock-based compensation, changes in accounts receivable and inventories and accounts payable, and then you get cash from operations, and then you subtract capital expenditures to get a very simple free cash flow to equity that does not include net borrowings, but they essentially have no debt, so there's no point to include it here. So look at how their capital expenditures to actually have the business running every year, they barely have anything to pay. They may have to pay some servers, they may have to pay some offices and stuff like that, but besides that, they're not a company that operates heavy machinery, so they barely have capital expenditures, which is fantastic. That means that as net income grows and as other things grow, for example, if they have accounts payable from other business activities, well, their free cash flow will grow as well. That's fantastic. So the cash from operations, even though the net income has been a little bit spotty, the cash from operations here, you can see it's a clear upwards trend. And in this trailing 12 months, it seems to have lagged behind 2022. We'll see when the last quarter is included, but in general, the picture paints pretty well. The only thing I'll note is that now that they're a public company, they are handing out stock-based compensation. This is included as cash from operations. It shouldn't be. It's an expense. So this figure should be a little lower, and in my calculations, I'll account for it, but they're ramping up the stock-based compensation a lot. That's noteworthy because one, it's an expense, and two, it dilutes you. If they're emitting more shares to give to the employees, then that dilutes the value of each of the shares you own. So that's something to keep in mind. Stock-based compensation is growing a lot, and that will be important if they have a year with low free cash flow for some reason. You also have to expense out the stock-based compensation. That may be negative. So it's just something to note. I'm not worried about it happening, but you always have to keep track of this number. Other supplemental items. So their shares out on filing date. They became public in 2021. So that's why you see this jump here from having 28 million shares to 33.8 million shares. They've still been issuing shares beyond that, however. So it's very important to note that they're diluting you still. Even without the stock-based compensation, they're diluting you. So this is not a company that buys back shares. They're still issuing shares, which means that the growth of the company should be way larger than the shares that they are issuing. That's something important to note if you want to make money from it. Another thing to note is growing book value. We like to see that. And their net debt, they have net cash, essentially. And their total debt is pretty much pennies. They actually managed to pay down almost all of those $20 million of debt that they had before. Great job accounting. And their net debt is now a net cash position. They have a little bit of cash. They have about $20 million in cash to play with if they want to do maybe a small acquisition, or if they want to just sort of shore up the company from different volatility things. That's great. That's fantastic. And some cash in hand, obviously, to create a website. If you create a website from scratch, if you create a system from scratch, it won't start generating revenue until it's created, until it's launched and clients are looking at it. So you need a little bit of cash on hand just to create it and pay people doing that. So it's healthy that they have this, right? And it means that they will need to emit debt in order to pay pay people, pay rent, etc. Okay, so I'm going to estimate the value of this company. To do that, first I'm going to go into Yahoo Finance. I'm going to look at the revenue predictions for 2023, essentially what their latest annual report will be, and 2024. I'm also going to look at the average percentage of revenue that gets turned to free cash flow. And you'll see here that it averages around 25%. I'm going to move that back down to 20. I think that's a little more realistic, these 37 and 27% numbers. I'm just going to call them outliers and just call it 20%. So we're saying 20% of these two numbers up here, 103.2 million and 118.54 million, are going to turn into free cash flow. Note that this is conservative. I'm being conservative for a reason. I want to see in a not so shining scenario, are they still worth it? So what I'm going to do is I'm going to plug those numbers in. So this is the free cash flow. I'm going to say that they keep growing by 10% in 2025 and 2026, which is less than they're estimated to grow in 23 and 24. And then from there on, I'm going to give them a perpetual growth rate of 3% and a required rate of return of 11%. That's 1% more per year than the market. Then I'm going to divide that by the total number of shares out. I'm going to get a fair value of $8.51. However, if we add the net cash position that they have, the fair value becomes $9.18 with net cash included, with an 11% rate of return and a 3% perpetual growth rate. Now let's see where this stock is at. Wow. So that's pretty much on the dot. So you'll see that I got this number, 8.51 and then 9.18, and they're at $9.12 right now as of March 20th, the end of March 20th. So that's pretty crazy. That's actually kind of funny that it's so on the dot here with this valuation. And if you see, on average, they've kind of hovered around this level. Sometimes they go up, and this would be a selling point for me. If I held the stock, let's say I bought it here at $8 and went all the way up to 14, I feel like I wouldn't be comfortable holding it because I feel like if anything happened, if anything, any bit of negative news could send the stock tumbling down 30%. So I feel like to me, and clearly this has happened before here, it happened here. So there are buy points here. I would have totally bought it at $7, like it reached a couple times here. There are selling points like $14. And all this since mid 21 when it became public. So it's still a fairly recent stock. It's still a fairly small company because the market cap is only $342 million. The P/E ratio is really high right now. That's only because earnings are, the net income is low, but the free cash flow is not necessarily as low. So that's something to note. A very high PE still does not necessarily always note overvaluation. Okay? So, overall, let's talk about it. In summary, it seems about fairly valued with some conservative assumptions. If you believe the growth rate to be way higher and a 3% perpetual growth rate, which was what I put, maybe underrating the business a little bit, maybe a 5% could be something that you like, or you want to just use the 20-year US bond rate, then this could be an excellent opportunity if that's more in your individual calculations than what I'm doing in my conservative one. Being an investor in this business, however, will require tracking the legal status of gambling across the USA, since growth is based on acquiring these audiences. Essentially, in the most states, the more states gambling and sports gambling is legal in, the more customers they'll have, the more people they can refer to these different gambling websites, gambling services, etc. And you should keep a watchful eye on stock issuance and stock-based compensation. That's my only other warning, because all the growth here is going to come from this company growing, from this company making more cash money, and then hopefully deploying that for acquisitions or further growth within their IPs. Now, the problem is this will be diluted by issuing more stocks and the stock-based compensation, which is clearly growing. So I'm going to say this is a company that I actually kind of like, and clearly there's a buy point and a sell point for this. So I would just keep a watchful eye on it based on this conservative estimate that I did, whether you agree with it or not. My last thought here is just to keep a watchful eye on your investments. With young and smaller stocks like these, it's important to keep an eye out to see how the stock-based compensation thing is going, how the net debt thing is going. All of a sudden, if they take out a bunch of debt to do an acquisition, how does that change the investment for you? And how just the general issuance of stock is affecting your investment. Is it diluting you by a whole lot or just by very little? Then it matters whether or not they're doing that in the first place relative to the rate of growth. Now, I hope you enjoyed this video a lot. This was a very fun company to analyze. And if you liked this and want me to look at other interesting companies, please feel free to comment down below. I'm always interested to see what you want me to take a look at. With that said, feel free to like and subscribe if you like this content. I love doing this content, and there will be much more of this. So with that said, have a great rest of your day.